Hi, welcome to Dig Into China. I'm Dong Shong. In the past few days, China has released its July CPI and PPI data. The National Bureau of Statistics have been working hard this year to keep the CPI figures positive each month, aiming to counter the narrative of deflation in the Chinese economy. Meanwhile, the central bank also published its second quarter monetary policy report. Although the Chinese government continues to deny that the economy is experiencing deflation, the central bank's report subtly acknowledged this reality. I suspect that perhaps only Xi Jinping remains oblivious. For China's central bank, the top priority is figuring out how to break the current deadlock, as maintaining price stability is one of its core responsibilities. To overcome deflation, the most crucial step is to restore market confidence. I've been saying for the past 2 years that China's interest rates are still too high. At this point, a substantial rate cut is necessary to alleviate the burden on people. Even if the government doesn't directly hand out money, at least it can reduce the debt repayments for the public. Unfortunately, there are numerous factors preventing the central bank from cutting interest rates, including external pressures, declining bank profits, bad debt, and the pressures from the central government. Honestly, after reading the central bank's second quarter monetary policy report, it seems clear that the central bank isn't unwilling to act. It's just being hampered by misguided directives from above. This report definitely comes across as an effort to shift the blame. But with Xi Jinping's level of reading comprehensions, he surely won't pick up on the subtleties here. So in this video, I'm going to delve into what the central bank is really telling us, the secrets they can't openly admit. Let's begin with the July CPI and PPI data. China's CPI calculation heavily weights food, with pork having a particularly large share. Since pork prices are very cyclical, I usually look at the more stable indicators to assess inflation in China, such as housing costs and durable goods. Imagine if a country's rent prices stay flat while prices for durable goods like appliances and costs continue to fall, with retailers offering discounts. In such a scenario, inflation levels are unlikely to increase. Even though the statistics from the National Bureau of Statistics may be manipulated, we can still see that the categories like housing, transportation, and communications are consistently dragging down the overall figures. This suggests that China's economy remains in a deflationary phase. We can also gauge corporate profit trends from the PPI data. Since July's PPI data shows little change from previous month, it indicates that the companies are still facing pressure on their profits. Without improving profits, business can't raise prices. Thus, it's evident that China's economy is still struggling. Now, let's delve into the central bank's second quarter monetary policy report. First, let's take a look at how the central bank describes the challenges facing China's economy. In the first half of the year, the external environment became more complex, severe, and uncertain, resulting in increased negative impacts. Global economic growth weakened, geopolitical conflicts and instability became more frequent, and the global environment worsened. Domestically, effective demand was insufficient. The economy showed signs of divergence. Significant risks remained in key areas, and there were growing pains in the transition from old to new growth drivers. Did you catch the wording? It deliberately avoids terms like overcapacity, deflation, or debt crisis, as if it's going out of its way to skid around these issues. But in reality, that's exactly what it's hinting at. I believe this is done so Xi Jinping won't understand, but we will. The central bank has made it clear that China's economy is facing both internal and external challenges. On the external front, they even included a special section on their expectations regarding the Federal Reserve's interest rate cuts, and I must say their assessment is quite spot on. The People's Bank of China believes that the Federal Reserve's ability to cut interest rates may face obstacles. With the current global instability, any outbreak of regional conflicts could disrupt international supply chains, driving up transportation costs and in turn causing commodity prices to rise. This would likely lead to a rebound in US inflation, making it difficult for the Fed to proceed with the rate cuts. I suspect this is one of the reasons China's central bank has been reluctant to make significant rate cuts. They worry that if US inflation rebounds and the Fed halts rate cuts, the widening interest rate gap between China and the US would make it harder to maintain a stable exchange rate. In other words, the central bank could make a substantial rate cut all at once, but doing so would require burning through a large portion of foreign exchange reserves to stabilize the exchange rate, which some might be unwilling to do. Besides external challenges, there are also internal issues. The People's Bank of China has subtly hinted at these internal problems, which seems to be a bit of word play. Only someone like Xi Jinping with limited comprehension might not grasp it. For example, terms like insufficient effective domestic demand and economic performance divergence essentially admit that deflation is occurring. When they mention significant risks in key areas, it implies that the real estate crisis is ongoing and local governments still face heavy debt pressure. The reference to growing pains in the transition between old and new growth drivers signals that China is struggling with severe overcapacity and difficulties in industrial upgrading. The central bank and the National Bureau of Statistics serve different roles. The central bank is responsible for crafting monetary policy and must address real economic issues, while the Statistics Bureau's job is to release data, often tailoring it to please the leadership. If the economy were truly problem-free, there would be no need for new policies. Therefore, the central bank cannot afford to ignore economic realities. I understand their predicament. To maintain the emperor's image, they have to navigate their statements carefully and show a strong desire to adapt. We've identified the challenges. What should the central bank do next in terms of adjusting its monetary policy? Let's examine this set of data. In June this year, the weighted average interest rate on new corporate loans in China was 3.63%, down by 0.32% from the same period last year. Last June, the one-year LPR ranged from 3.65% to 3.55%, following a 10 basis point reduction on June 20 last year. The 5-year LPR was between 4.3 and 4.2%. This June, the one-year LPR is 3.45% and the 5-year LPR is 3.95%. This means the one-year LPR is 10 to 20 basis points lower than last year, and the 5-year LPR is 25 to 35 basis points lower. However, the interest rate on new loans issued by banks in June this year is only 32 basis points lower compared to the same time last year. What does this imply? It indicates that the banks are not significantly cutting their rates. Typically, banks set the loan rates by adding their own margin on top of the LPR. For example, if you apply for a loan and the bank offers a one-year loan rate of 4%, it means the bank's margin is 55 basis points above the LPR. This data reveals that the banks are mostly following the LPR changes to adjust their loan rates, but are not actively lowering their own margins. The takeaway is that financing costs for the real economy remains high because although the central bank adjusts interest rates, banks are not proactively reducing their margins to make borrowing cheaper for businesses and individuals. Some might argue that if banks are offering primarily one-year loans, there must be some margin reductions. However, a large portion of new corporate loans is actually in the form of medium to long-term loans, which the Communist Party often boasts about. For instance, by the end of June this year, medium and long-term loans to the manufacturing sector had increased by 18% year-on-year, reflecting a thriving manufacturing industry. Yet, the real issue is that while it may appear that the banks aren't actively reducing rates overall, the actual loan structure paints a different picture. The central bank's report shows that in June, 50% of general loans had interest rates higher than the LPR, 6% had the rates equal to the LPR, and 44% had the rates below the LPR. Additionally, the weighted average interest rate on newly issued inclusive microloans in June was 4.4%. What does this tell us? Clearly, banks are favoring state-owned and central enterprises which receive nearly half of the available credit at these low, possibly loss-making rates. On the other hand, small business, even with the benefits of inclusive financial policies, still face an average loan rate of 4.4%. Do you consider this rate to be high or low? In China, consider which small business sectors can achieve profits that surpass the cost of bank loans at 4.4%. This can help determine whether the current loan rates are high or reasonable. From a risk management perspective, higher rates for small business are justified due to the higher risks involved. However, when considering support for private enterprises, these rates seem excessive compared to the 1% or 2% rates frequently given to state-owned and central enterprises. Additionally, some local state-owned enterprises benefit from special zero-interest loans. Since banks don't profit from these state-owned projects, they compensate by charging higher rates to private businesses. I also carefully compared last year's second quarter monetary policy report and found that, first, the share of loss-making loans with interest rates below the LPR has increased considerably this year compared to last. Last year, only 38% of loans had rates below the LPR, but this year, the proportion has risen to 44%, marking a significant rise. Second, the interest rate on inclusive microloans for small business was also 4.4% last year. This indicates that the banks have not alleviated the financial burden on small business this year. They haven't even passed on the benefit of LPR rate cuts. The conclusion is clear. The central bank's data reveals that the banks have been favoring state-owned and central enterprises this year, providing them with a substantial amount of low-priced, loss-making loans. Meanwhile, private and small business have faced heavier financial burdens. Thus, the Communist Party's loud claims of supporting private enterprises this year are merely empty rhetoric and a deceptive promise. To summarize, China's economy continues to grapple with serious issues such as deflation, debt crisis, and overcapacity. These challenges are acknowledged, albeit indirectly, in the central bank's latest monetary policy report. There are reform-minded individuals within the central bank like Professor Huang Yiping, a member of the Monetary Policy Committee, who has publicly criticized the macroeconomic decisions of recent years. It's evident that the central bank likely wants to avoid being blamed for these problems. As a result, this year's report is more candid than last year's, presenting data more openly. However, few people take the time to thoroughly examine such comprehensive reports. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, stay well.